Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is August 11th of 2022, and we finally got it, right? We finally got that report that showed what our data has been signaling to us really over the last 6 to 8 weeks, which is inflation is finally starting to slow. Now, when we had that other inflation report back in July that showed June's data of accelerating, one of the things that we cautioned investors on was that that was June data, not July data. And you have to pay attention to what the back half of June did and what the data was saying, that high frequency data was saying in July and, of course, early August. And whether you're looking at commodity prices, whether you're looking at gasoline prices, whether you're looking at wholesale inventories, the message was clear. Inflation had peaked in mid-June, combined with an accelerating response by the Federal Reserve with 275 basis point rate hikes. Those two moves in particular, I think, have really started to settle into the economy. The economy is slowing, demand is slowing, and you're seeing that reflected in finally decelerating inflation numbers. And we think bottom line here is that that's going to be good for asset prices between now and the end of the year. Now's the time when you get involved. You don't wait for that data to fall all the way back to 2%, because once inflation is back down to 2%, markets, in our opinion, will be significantly higher from where they're at right now. So now's the time to act. Now's the time to respond. Now's the time to be disciplined. So let's go ahead and get started for the week. We're going to be talking about disinflation. Has it truly arrived? Is this a one-off report, or is this the first of many reports? And most importantly, what does it mean for your money? We'll do some short-term trading snapshots in terms of where we're at with certain resistance levels, whether things are overbought, obviously not oversold, but what does the market need to do next to really get over that next hump? Lastly, we're going to go over some of the short-term trading risks that remain here in the market. Now, before we move on, I do want to point out this cover. This was the cover on June 20th of Barron's Magazine, that basically markets are bad, but they're about to get a lot worse. And you start to see covers like this near the bottom or top of the market, right? Where near the top, you tend to get, hey, this is going to go on forever in terms of the market rally, or near the bottom, it'll never get better type of message. Once it reaches the front page, ladies and gentlemen, that's usually the sign that you want to start to lean in and do the opposite. And that's what we've been stressing since June. Now, as it relates to inflation, the inflation report that came out this week, that year-over-year number, not that dramatic, right? So from a political perspective, you're not going to have the government out there going and saying, hey, they're making great strides here. 8.5 is still high. But from a stock perspective, the only thing that matters is, has the trend started to go the other way? So by the time you get 8.5 to go all the way back down to these levels here between 2 and 3%, there's going to be likely a significant asset repricing as that takes place. By the time you get to these levels, the opportunity is gone. So now is the time that you look at the data and say, is this a one-off report, or is there continuity? Is there longevity to this? And let's take a look here real quick in terms of the contributors: airfares, gasoline, used car prices. Again, if you've been paying attention to what we've been saying, we've seen this been happening live in real time, especially those gasoline prices day in, day out. Just broke $4 today to the downside, $3.99, $3.98 or so per gallon. We were at 501, 502 just what was it, 4 to 6 weeks ago. So again, very good that we're getting those positive tailwinds. Electricity, food, and shelter, the next things we really need to see come down. Shelter in particular is the big one that continues to rise at a level that we would not be comfortable with. So we want to see that one come back in. The month-over-month change was huge in terms of, we were at 1.2% or so last month, or 2 months ago. In July, we actually went negative. So again, lots of signs there that the 275 basis point rate hikes are really starting to slow the economy down. That's good for your position in growth assets like we are. And it's beginning to take that demand down, which should slow overall inflation. And the last analog to this time period is really the 1982 to the 1983 time period, which is we had really high inflation, 14% interest rates, or 14% interest rates near the end of it. And this is when Paul Volcker came in and started to hike rates like crazy. And that led to a 27% bear market in the S&P 500. So how long did it take? Once the market was comfortable that there was a trend change, notice what I said there, a trend change, not a change back to the lower trend. In other words, we weren't all the way back down to 2, 3, or 4%, but we were starting to go into that direction. Once the market became comfortable with that, which means not just one report, but maybe 2 or 3 reports a month over month, it took about 4 months to reverse the 27% loss, right? Now, everyone out there is going to say, well, 27% means you got to get 35 to 40%. Ignore all that, right? Mathematically true, but markets reprice aggressively in a very short time period. So you also have to remember that. So bottom line here is now is the time to go on offense. And we always want to, in our opinion, you kind of want to lean in and do the opposite of what the crowd is doing. There's only been 3 other times since 1995 that stocks have been this oversold, okay? So the other 3 time periods, the March 2020 low, the March 2009 low, and those post.com lows between 2001 and 2002. So when you look at the numbers and how oversold we are, the math is on your side. The overwhelming crowd right now is scared, they're fearful, they're pessimistic. Even with the recent rally, everyone out there, it seems like, is saying that this is a bear market rally, it's a bear trap, all of these things that dominate the headlines. Meanwhile, at some point, bear market rallies turn into bull market rallies. Every bull market rally starts with short covering, starts with excess cash, starts as a bear market rally until it's not. So this is very important. These are your very important things to remember. Now, in terms of the performance chase, right? When we're looking at these short-term trading indicators, hedge fund net positioning remains record low in terms of their stock market exposure. So as markets start to run, the hedge funds have to start to get back on side into the market because otherwise they start to lose performance fees. It's called the performance chase. And when you look at overall net exposure to equities across the entire market, it's also near record lows. So you have hedge funds, portfolio managers of mutual funds, advisors across the board don't want to start to fall behind the market too much. So they have to start to chase it. It's called a performance chase. That's when you start to see the scenario of a potential melt-up rally as all these investors that are sitting in cash try to catch up to the market. And on top of that, we have volatility collapsing. So volatility all the way 35, 40, everyone out there, you got to hit 40 before you touch the market, right? Everyone's waiting for that 40 level. And they didn't quite get there. 36, 37, I think, is where we probably peaked out at. That was actually back in that March time period, I think. Now, here's the thing. VIX did pierce 20 back in April, but that was also when credit spreads were rising. This time around, we've pierced 20 and credit spreads are plummeting, right? So just a quick reminder, volatility is that demand for portfolio protection. So the demand for put options, which bet that stock prices are going down, versus their equivalent call option, which is the bet that stock prices go up. So when the demand for VIX, or sorry, the demand for puts is much higher than calls, VIX goes up. So you don't want to see that. When VIX goes down, that demand for portfolio protection is going down. Now, the difference this time around between late March, early April, and today is that as VIX pierced 20 to the downside, look at what credit risk spreads were doing. They were going up. You don't want to see them going up. You do not want to see implied credit risk going up. These are the pencil heads on Wall Street. These are the ones that spend their entire day looking at balance sheets, right? So when they're saying credit risk is rising, market takes notice. Now, what we see is that credit spreads are actually rapidly declining, in line with what VIX is doing. So when you have all the different asset prices that are moving in conjunction, trying to tell you the same message, hey, things are not that bad, pay attention to it. It's okay. You can pay attention to the data. You can pay attention to what the market's trying to tell you, and then take action as needed, right? So it's important. We want to pay attention to those symptoms. And then, of course, gasoline breaking $4. Now, right now, we actually do expect that the net impact to the inflation report in August will actually have a greater downside impact than in July, or sorry, than in June, in July. And but the bottom line here, to make these really simple, we pierced $4. We were over $5 just in June. So this is as simple as it gets. Gasoline prices go down, U.S. consumers feel a lot better. There's more money in their pockets. Just keep it simple. That's good for the U.S. consumer. The one thing that has not been disinflationary, and we are playing on the inflationary side, new auto inventories. While used car prices are coming down and those inventories are actually going up quite a bit, new auto inventories remain near lows. And we're playing that through the two, what we think are the two market killers, or sorry, the market leaders. Killers being their category killers. The EV leader, unabashed EV leader, Tesla, and Ford. Why Ford? We just love their simple business model. They got 3 core models that we like in particular, that Ford F-150, the electrification of the Ford F-150, the electrification of the Ford Mustang, and of course, the Ford Bronco. Those 3 category killers versus GM that's got a gazillion models. No one really, when you think of GM, no one thinks of one car in particular or 2 or 3 models in particular, just kind of a vast assortment of product. We think Ford has a very narrow subset category that they focus on and they capture market share, and we like that. It leads to better margins. Same with Tesla. So this is how we're playing the low auto inventory within the portfolios. As it relates to the factors in that factor matrix, again, right now we're in that the economy, we believe, is slowing towards 0 to 1% GDP growth. In that type of environment, you want to own companies that can grow fast in a low growth environment. In other words, shift out of value and into growth. The top right quadrant right here, that's where we're focused on right now. Not recession, not accelerating growth in the economy, but right here in that top right quadrant. So the bottom line, inflation report this week confirms what we've been pounding the table on over the last 6 to 8 weeks. We do believe inflation peaked in June. The last thing we do want to see, though, are those shelter costs coming down. That means, fancy way of saying, rents. Right now, rents are accelerating way too fast. That's the one rub in the report that we want to see improve here over the coming months. Some signs that is beginning to ease back a little bit. Wall Street is positioned very defensively. That's bullish. You want to get in front of that because eventually that cash has to get deployed to catch up to a recovering market. And then lastly, new auto inventories remain lean. We're playing that through Tesla and Ford, which should be good, of course, just broadly speaking for new auto manufacturers. That's what we got for you this week. Please reach out to your local advisor if you've got any questions. Reach out to us, 888-543-3776. Hope everyone's doing well. Again, have a great and fantastic weekend, and we'll speak again next week. Thank you.